Today we're going to be talking about the experiment of trading and objectivity. So what does that mean? This is one of the most important lessons for a trader who's just starting out. Before you get involved in a trade, before $1 of your money is at risk, you look at a chart, you create a thesis. Okay, at that moment you are the most objective you are going to be throughout the entire trade. Why? Because none of your capital is at risk. And being the most objective, you will have the clearest picture of what is truly going on. The minute that you enter into a position and your money is at risk, you as a trader will become subjective. That is why, as a trader, you need to set up your trade and then almost let it play out. So I call it, it's like an experiment. You set up your trade and you let the experiment play out, and you either make or lose money. So what does this mean, you set up your trade? When you're still objective, before you risk any of your capital, you need to figure out what are you looking to make on the trade and what are you willing to lose on the trade. This gets into a very important topic of risk and reward. In general, your reward should be at least 3 times what you risk. We can get into that in detail a little later, but the idea is, briefly, that you want to be able to profit 3 times as much when you're right than when you're wrong. That way you can be wrong many times and still make money. This is an idea about skewing numbers in your favor, which is also a topic we will discuss later on. When you're still objective, what you need to do is you need to set a stop in a trade. What I say to any trader is that you need to know where you're going to get out when you're getting in. What that means is that if you get into a trade, you know you're going to risk 10 cents. This is a game of math, so it should not come as a surprise to you that, oh, I lost $500 in that trade. How did that happen? Everything in this business is quantifiable. So you should know if you're buying a $10 stock, or if you're buying 500 shares of a stock and you're willing to risk 20 cents, that you're willing to risk $100. It's a very simple mathematical formula. What you would do is you would get into the position and then you would immediately set your stop. Stops are one of the most important tools for a young trader. Once again, you set your stop when you're still objective in the trade. Why do we do this? Because psychologically what happens is as the trade moves against you, you may say to yourself, well, I'll get out at 20 cents. Then the stock moves 20 cents against you. Well, I'll give it 5 more cents. Stock moves 5 cents against you. I'll give it 15 more cents. And you play a game with yourself. And soon enough, you find yourself, you're down $1 on 500 shares. Not a place that any of us want to be. So I like to say, use your trade as like an experiment. You get in, you set your stop, you set where, you can set a trailing stop as well, which we can talk about later on, and you let the trade run. And either you get stopped out or the trade runs and you execute and you profit.